Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday the 6th of September 2020. And yesterday we published our gold and silver weekly update for the weekend in the 4th of September. And on Friday we published a video entitled Positive Non-Farm Payrolls Upset Equity Markets, Gold and Silver Down, where we highlighted that despite a rise in US COVID-19 infections, economic data is suggesting a small but existing uplift in the US economy and a somewhat faster than usual recovery in jobs, or certainly faster than expected recovery in jobs, though most economists admit that it may indeed take some years before pre-COVID rates of employment will be reached again. We also pointed out yesterday that equity markets are vulnerable, and many analysts and political commentators are suggesting that we should not be surprised to see volatility, if not turmoil, in the various exchanges as we approach the November 3rd presidential election. Now, of course, the question on all our lips is, will gold and silver be the net beneficiaries from such turmoil? And let's all be honest about this. We would suspect, logically, they should be and probably will be. That being the case, we have to ask, then why have central banks slowed down their rate of gold purchases? We've often seen headlines highlighting, really over the past 2 years, the vast amounts of gold a significant number of central banks have been acquiring. So why are they now slowing down? Now on Friday, Bloomberg published an article highlighting this, quoting the World Gold Council. We shall show you what Bloomberg says. Bloomberg article dated 4th of September 2020. Headline: One chart shows who is turning away from gold. Central banks slowed gold buying this year, with July volumes at lowest since 2018. And as you can see here by the graph, that monthly net purchases by central banks, you'll see a peak here at 134.7 tons last year, and it's down in July, here we go, to 8.8 tons. So, in June last year, was it June? Let me just double check. Trying to get this to work. 1st of June 2019, 134.7. And now currently in July of this year, 8.8. And this is the sourced from the World Gold Council. Let's carry on with the article. Central banks' net purchases of gold fell below 9 tons in July, the lowest since 2018, World Gold Council data shows. After 2 years of big buying, demand has eased in 2020, as some nations curbed purchases. Prices hit a record, and the coronavirus crises rippled through the economy. While the Council expects bullion reserves to keep rising, the slower pace would curtail an important driver of gold's advance in recent years. Okay, that sets the scene. Now a site entitled Live Mint goes further and suggests why this has been the case. Let's take a look. Live Mint article dated 30th July 2020. Headline: Central banks trimmed gold purchases between January and June, World Gold Council. The latest demand trends report by the World Gold Council showed that global central banks bought 233.4 tons of gold on a net basis. This is 39% lower than the 385.7 tons seen in half one of 2019, the highest level of half one net purchases since 2000. Central banks, one of the key participants in driving investment demand for gold, cut their purchase in the first half of this calendar year, H1 of 2020. The World Gold Council's latest demand trends report showed that global central banks bought 233.4 tons of gold on a net basis, 39% lower on a year-on-year basis. Also, this number is 6% lower than the 10-year H1 average of 247 tons. Global economic uncertainty has massively increased investors' appetite for safe haven asset gold. In the first half of the year, this precious metal nearly provided 17% returns in the international market. In the same span, the MSCI World Index was down 7%. On the 29th of July, gold prices hit an all-time high intraday of $1,981 an ounce. Of course, it's been higher since then. Gold prices are expected to rise further, aided by gloomy economic recovery outlook and historically low interest rates worldwide. The World Gold Council said that buying has become more concentrated, with fewer banks adding to reserves in 2020. We feel that one deterrent for the central bank was prices. In the first half of 2019, gold prices were quoting around $1,350 an ounce on average, while in H1 of 2020, average gold prices were around $1,700 an ounce. Sriram Iyer, senior research analyst at Reliance Securities Limited, said. It should be noted that global central banks purchased a record of 385.7 tons of gold in H1 of 2019. The report highlights that the second quarter marked the first quarter since Russia, a major gold buyer since 2014, suspended its gold purchasing. Further, in the June quarter, purchases were also more concentrated than seen in recent years. During the quarter, 6 central banks increased their gold reserves by a ton or more. This compares with an average of 9 over the last 12 quarters, the report said. Tapan Patel, senior analyst for commodities at HDFC Securities Limited, is of the view that a temporary pause in gold buying from central banks is likely, as many nations may sell some of the gold to tackle the current economic slowdown. The major central banks from the world have bought record gold in the year of 2019, which was the highest in 50 years. The exhausted limit of gold buying from most of the central banks has resulted in a slowdown in H1, half one, of 2020, he added. Turning to net sales, the first half of the year saw a rise in the number of banks reducing their gold reserves by a ton or more compared to the same span last year. This comparison here is 7 versus 2, but despite this, the absolute volume of gold being sold during H1 was modest at 42.5 tons. Considering that global economic recovery would be prolonged, the World Gold Council expects central banks to remain net purchasers in 2020, mainly due to negative interest rates. However, volumes could be below those of the 2 preceding years. So, we can see from that article from LiveMint a few propositions as to why central banks have slowed down their gold buying rate. 1. Prices have risen significantly. 2. They may be, that central banks, more interested in selling gold now to cover other expenses due to the economic slowdown. And 3. Some may actually feel that their exposure to gold and precious metals as a form of capital reserves is sufficient. Now, it's important to be mindful that when one analyzes the investment market, there are a number of catalysts and momentum drivers which have an effect on the type of investment an institution or central bank undertakes. We would add another reason why gold purchases are slowing down. It's because central banks are spending so much of their reserves and money on government and corporate bonds, and if not already, on mortgage-related securities. And therefore, there are less resources available to spend on gold. We often hear the pumpers telling us that gold is going to $10,000 anytime soon. But we ask the simple question, who's going to buy it at $10,000? Or $9,000? Or even $8,000? Central banks won't, and they've been a major purchaser of gold. If they're struggling to pay $2,000, why would they pay $8,000? The general public won't, not now, because they don't even have enough in the main to pay next month's rent or mortgage payments. Large institutions are often curtailed by their own investment rules and charters, that they cannot expose themselves above a certain percentage in such assets such as gold. Unless, of course, it's a gold investment trust or gold precious metal related fund. That's different. And we in the stacking community, as I see us, despite our enthusiasm, simply do not own enough wealth between us to move markets sufficiently to get the prices to those levels. Well, that then leaves us really with the only other alternative, and that would be the virtual collapse of the US dollar. But as we've often quoted, yes, you'll have $10,000 gold then, but a loaf of bread will be $10 to $20. A car will cost you $100,000 instead of $25,000. So where's the benefit, other than maintaining your own purchasing parity, which is of course important? And whilst even we can see the dollar weakening a little, we're not anticipating its complete collapse or sufficient collapse to push gold suddenly overnight to $10,000. And if it does occur, and suppose we're wrong, it does occur, and the system has no clear alternative, then the Armageddon situation we've mentioned in previous videos could indeed sink in or kick in which case then we shall be more interested in looking after our welfare than our gold deposits. If households are struggling when bread is $1 to $2 a loaf, how will they cope when it's $10+? And the same with other but larger household expenses. Now that said, over time we could indeed see a gradual rise in gold prices, as we have seen over the last few years, particularly as the economy improves and investors begin to fear the prospect of inflation. But that, we suggest, is still a little way off. So we should at least acknowledge what central banks are doing. And whilst their activity does not dictate the underlying price, it does have an influence. For us, it's all the better, as any pullback in gold prices will deliver a further opportunity to acquire more. What is interesting, though, is what's happening to silver right now. Unlike gold, silver is nowhere near its all-time high. And later today we shall be publishing a video specifically on silver, which we hope you will find most interesting. So do watch out for that one, and that will be uploaded to YouTube at around 1800 hours GMT +1. Meanwhile, do share your thoughts and tell us what you think about central bank gold purchases slowing down, and whether you can see them picking up again, and if so, under what scenario. Thank you so much for listening, and if you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they are published. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.